For all of you that work with higher net worth individuals, the one thing that they all want to know is how much capital do they really need to set aside for themselves to have a secure future. And it seems like no matter how much somebody has, they never think it's good enough. They think they're going to run out of money. To the extent that you can make them feel very confident in the amount that they do need to set aside for them, the easier it will be for them to identify then what is excess capital. That is capital that they'll probably never need for the rest of their lives. But as long as they know they could get at it if they needed it, they're more likely to do something with that excess capital and lever it up through life insurance to do even more for those people and things that they care about. So what I want to do is I first want to start with a little bit of our roadmap web-based planning software to show you how we prove to a client in front of them how much capital they need. So let's take a look now at the web-based roadmap screen. Now, as you can see here, I'm going to assume for a moment that we have a 68-year-old individual, 68. And the question he's asking is that if he retired today, how much capital does he need for himself? And let's suppose that he says, my tax-free goal is $300,000 a year. He wants to assume 2% inflation. So I want $300,000 growing at 2% inflation, and I want to assume that I'm going to die at age 90. So we're going to begin retirement today at 69. We're going to kill him at age 90. And the only other assumption that we're going to assume here is inflation of 2% and that the rate of return that he can earn on his money is 4.5%. So 2% inflation, 4.5% return on money after tax and investment expense. So we go down here and we hit save and continue. On the next page, we scroll down and we hit generate results. And on the top scroll bar, it says retirement income legacy scenario. We click on that. And what we find is this. With a $300,000 goal, growing with 2% inflation, he's got to have assets that can deliver $8.4 million of cumulative tax-free income. If he can get 4.5% on his money, he would have to reserve $5.3 million after tax today in order to make that happen. Now, this $5.3 million number is going to be in the PowerPoint that you're going to see that we call me versus excess capital, or said differently, how to take money that somebody is really most likely never going to need and lever it up through life insurance inside an ILIT. Now, I want to remind everybody that this $5.2 million is the amount of capital that he needs at a 4.5% growth rate, and all of it would be gone at age 90. Now, one of the other things I like to do, instead of using a 4.5%, where I would need $5.3 million, I like to take the 10-year Treasury rate and make this a risk-free environment. So what we do is we go back to the client profile page on our inputs, right here. We go to our interest crediting rate. So instead of 4.5, let's make it 2.2%. That's the 10-year Treasury today, mid-January 2016. We scroll down, save and continue, scroll down, generate results, go back to that tab, and now at a 2.2% growth rate, I need to set aside $6.6 million to meet my $300,000 goal, growing with inflation to age 90, and I would have nothing left at age 90. So if I have a $15 million estate or a $10 million estate, I now know that I need $6.6 million for me and my bride. That frees me up to take the excess capital. So this is what I call the me capital. The excess capital is the difference between the value of the estate and that number. Theoretically, I can use that, loan it to an ILIT, and let the ILIT lever it up through insurance. Now, why do I loan it? Because I still could have access to the money if I ever need it, even though I have really proven how much the client needs. So now let's look at the PowerPoint that follows up from that roadmap web-based platform presentation. Mr. Client, you've got assets. And in fact, what we want to calculate is how much money will you absolutely never need. There's some amount you'll die with, but can we really calculate at the end of the day with you having a $15 million net worth? Can we calculate what I call me capital? The amount of money that you've got to set aside for you and your spouse to live the way you want to live for the rest of your life adjusted for inflation. If we can calculate what that amount of money is, everything in excess of this amount is what we call excess capital. It's money theoretically you're never going to need, but I'm going to make sure in our planning that should you need it, you always have access to it. Now, with respect to this excess capital, let's just say for a moment it was $9 million. So in other words, your me capital, let's say, is $6 million. If you knew that you were never going to need this $9 million and you were going to die with it, would you want it to be worth $9 million, or would you want that to be worth $40 million to do more for those people and things, charitable pursuits that you care about? Without a doubt, you'd want it to be worth 40. Now remember, the key is we want to make sure you have enough capital for yourself. If you ever need any of this excess capital, that you can get to it. But at death, whether it's today or 40 years from now, we are going to make this money explode into a much larger sum than what would be there otherwise. So Mr. Client, you said you were 68 years of age, and you wanted $300,000 a year of after-tax income growing with 2% inflation. So you've got to have assets that can deliver $8.4 million of cumulative tax-free income. Now, assuming that you can get 4.5% on your money, you would need to set aside $5.3 million for you. Now, remember, everybody, that was the original number we used on the web-based planning platform. So you need to set aside $5.3 million, getting 4.5, and by the way, it would meet your goal, but everything would be gone in this example at age 90. But let's use $5.3 million as your excess capital. We like to call it the family bank trust. So if your client's name was Johnson, say, Mr. Johnson, I want to show you how we're going to create the Johnson Family Bank Trust. Essentially, the client is going to lend some amount of the excess capital to the trust. Not gift, lend. It's still an asset that the client has. He still has access to this money. It's on his net worth statement. The trust is going to purchase the policy. The cash values are going to grow. This is rarely a GUL. This is almost always an indexed single or joint life, depending on the complexities of the case. But I want the trust to be able to use cash values during the client's life to do things for trust beneficiaries, the kids, so on and so forth. Because having that cash available is important, not only to take advantage of the kids, but if the client ever wants any of this money back, the cash value will be there to pay back the loan that the client made. So, death benefit is owned by the trust, income and estate tax-free. So, Mr. Client, with the $15 million of net worth, we've established $5.3 million is your me capital. Remember that? Yes. That then means that $9.7 million, theoretically, you're never going to spend. Now, in this example, what I want to do is I want to take that $5.3 million of your capital that you need for you and your spouse, and what I'd like to do is take another $7.7 million of this 9.7. So even though we don't need this for you, I want you to spend, think about it, $13 million on you and your spouse You've worked your lifetime to make this happen. With the understanding that we're going to recreate way more than what you would have done otherwise, because what we're going to do is take this other 2 million. So remember, 15 million, 5.3 for you. We're going to take 7.7 of this 9.7. That leaves 2 million left. We are going to loan it to your family bank trust, and the trustee is going to buy a $10 million income and estate tax-free death benefit to benefit those people and things that you care about. Now, if I did this with $400,000 a year for, in this example, 5 years, took $2 million, bought a $10 million, the trustee did, of income and estate tax-free insurance, what's really interesting when you look at all of this is what did you get? Simply this. You got $13 million to spend on you and your spouse. You've earned it. The $2 million that you're not going to spend, you've loaned to the trust. You're probably never going to need it. But if you do, the cash values will be there to take advantage of all this. You're going to accumulate millions of dollars of cash value in this policy. Millions. That trustee could use that cash to loan it out, to buy help with a down payment on a house for your children or grandchildren, or to start a business and so on. The Roadmap web-based software is critical in establishing the me versus excess capital presentation and to create the family bank trust. Thank you.